Hello, everybody, and welcome to the Trading with Ashley show. I cannot talk about NVDA without wearing my NVDA green. I am very excited about this upcoming week. NVDA reports earnings on Wednesday, and I want to make sure you are super prepared. This could define how the stock market performs for the remainder of the year. This is one of the most highly anticipated earnings that I have ever seen in my trading career. I want you to be prepared. A lot of traders are afraid of earnings. I personally like to capitalize on earnings. I like to make my trades safer so that I go further out and I go really wide in the strike prices I'm selecting. Now, I want you to be aware NVIDIA is expected to have a 10.9% move either way. That's actually the highest predicted move that we have seen over the last 10 earnings calls. So it's going to be very interesting and very volatile. Volatility plays a key role when you are an option seller like me. I actually welcome it, I embrace it, and I use it to my advantage. So I want to explain to you about how volatility can help you in this dynamic. And I'm going to show you several different ways to trade NVIDIA so that you are ready and prepared for this week and you can make money off of NVIDIA either way it goes. If you don't have NVIDIA shares and you want exposure to NVIDIA, I am going to show you how to sell a put, and I'm going to show you a trade hack on an ETF that actually outperforms NVIDIA. Can you believe that? And then if that's not enough, I am going to show you how to do a put credit spread. And I'm going to look at strike prices that go well below the drama and far enough out to avoid any real risk to your portfolios. So there's a lot in here and it's very technical, but I'm going to make it very easy for you to understand. If you like the way I teach and you want to join a group of over 500 investors that were all focused on the same thing, and that's making great money, consider signing up for a call to discuss my Discord. It is a private community. It's a paid community. However, it is a bustling, thriving, very positive community. Our first order of business is to key in on price action. We need to better understand this predicted potential move so that we can adjust our trades accordingly. So the easiest way that I have found to do this, if we are looking at a 10.9% move up or down, I'm going to show you how I calculate that. First of all, I am going to round up. I want to be a little bit safer, so I am going to assume a 12% move up or down for starters. So what you would do is you would take the current pricing rounded up to $130. To get the 12% down potential price, you would take $130 times 0.88. That is going to equal $114.40 is the potential low. If you want to calculate the potential high, you would take the same $130 and multiply it by 1.12. That gives you $145.60. Now that we have those bookends, let's go look at some potential plays so that we can try to keep our trades safe and out of harm's way. Another thing to consider is the Bollinger Bands. So let's go look at those. I am going to look at the 3-month chart. The further out you go, the more time is in the equation, and that actually helps you make a safer trade. So we have our 12% potential move, assuming that we're at about $130. Now that could jump in the morning, so you'll adjust accordingly. But looking at our bands, if we want to be extremely safe, we would want to look at the bottom of the band. Here it is at $94.26. So you can mark about $95 as a potential trade. If you want to be even safer, look right down here at the 200-day moving average. That serves as a good support system for a strong stock, especially one as popular as NVIDIA. That is sitting right there at about 85.50. So now that you have those marks, we're going to go searching for potential trades so that we will be able to maximize our money but protect our portfolios. Just to recap on the downside, the 3 price points I want to consider are $114, $95, and $85. Let's take into consideration the other part of the equation. This is implied volatility. As I mentioned, implied volatility will help spike premiums on puts or calls. If you look up NVDA and look at their average implied volatility, you're looking at about 70 for the 20-day moving average. Let's go see, with earnings around the corner, what the implied volatility is right now. Knowing that the average implied volatility on NVDA is 70, I want you to look right here. This is looking at a cash secured put for this Friday. If you were to take a play and sell a put, you're looking at an elevated implied volatility of 100. Now, with elevated implied volatility, you will get more premium because you're taking a larger risk. So I want to be upfront about that. You will enjoy elevated premium, but you also have elevated risk as such. Next, I want to take you to the actual option chain so we can look at different potential sell-put opportunities. The first thing to note that if you are going to sell a put on NVDA, you must have enough cash for at least 100 shares of the stock. So if we want to sell one put on NVDA, if you are going to select a strike price, let's assume we select something around $100 a share, you are going to need $10,000 to make that trade. If you have a strong belief in NVIDIA and you believe these levels will be respected, you have a few decisions to make. The first one is the expiration date. If you would like this play to be over by the end of the week and know at the end of the week whether you're going to be the proud owner of 100 shares of NVIDIA, or if you're going to receive great premium and get all your money released to you, then you would want to select August the 30th because that's going to be a few days after earnings where elevation is the highest on our implied volatility. Let's start at the most conservative side of the trade. Remember, we had seen that $85 is a strike price. It's right there at that 200-day moving average, and it serves as support. So if we are interested in that particular trade, we would want to go look at it on the option chain. It does appear that there is quite a bit of open interest, 16,000 for the $85 strike price. If you put up your cash, at this point we'd need $8,500, you would receive $20 in premium. What you do is you take this 0.20 and you multiply it by 100, and that would show you what premium you're going to be paid for putting up your cash to buy somebody's shares at the $85 mark. Now, why would the other party be interested in buying a put from you? They want to make sure if the price starts to drop, there's somebody that will take their shares off of their hands before they lose too much money. So maybe they selected this $85 strike because it's just not that expensive, but it does offer some protection for their portfolio. Also, if NVIDIA does start to fall and they make this purchase, then this will start to gain a little bit of value. That's what more than likely these open interest dynamics right here and this volume right here are individuals that are interested in protecting their portfolios to the downside. Well, in comes you saying, I'd be happy to take your NVIDIA off your hands for $85. They're going to pay you $20 for you putting up the money for a few days to do that. Let's go to the next strike price we had looked at. We had looked at the $95 strike price. Look here. It looks like everybody's thinking the way we're thinking. There's 14,000 in open interest and about 2,000 in volume as the time of this recording. If you look at $95 strike, you'll need $9,500 to sell this put. For that, it looks like you'll receive about $32. So a little more than what we had seen at the $85 mark. Moving up to the expected move for this stock, we had settled in on 114. There's about 8,000 in open interest on this play. For this, if you put up the 11,400 to sell a put, then you would be receiving $1.62 a share, which is going to be $162. Not bad, especially if NVIDIA starts flying high. Now, if you select this strike price and NVIDIA shoots downward, at first, it's definitely going to look like your trade is losing because if you sell this for $162 and NVIDIA starts moving down, this right here, 162, is going to change by our delta, which is at this point 0.16. So 16 cents will be added to this figure every dollar NVIDIA moves down. But what's most important is where NVIDIA settles in on its expiration date, which is Friday, August 30th. If NVIDIA settles in above 114, then you would keep 100% of this $162, and then your money would be released to you. Now, if you have a super strong belief that NVIDIA is going to fly off the shelves, then you could do something a lot riskier, and you could come up here to, let's say, the 125 strike. There is a lot of open interest. There's also a lot of open interest at 121. The most open interest I see on this chain is 120. So you can look at these different open interest dynamics to determine where institutions and individuals are placing their trades. If you wanted to take on a little bit more risk and use $12,000 to make this trade, you would receive $310 in 1 week for putting up that $12,000. That's a really good return. Worst case scenario is NVIDIA would fly down below 120. You agreed to take the shares at 120. So if you were to put these shares at 120 and NVIDIA was trading lower than that, you would have to hold on to those shares until NVIDIA decided to wake up and start going up again. Now, one way you can make all of these trades safer and get paid more premium is just by going further out in time. I am of the belief that the market will be doing really well towards the end of the year due to the election. That's traditionally what happens in election years with the stock market. Usually November, December is usually humming along pretty nicely. So if you want it to go further out, you would be tying up your money a little bit longer, but you could go ahead and look at expiration dates. Maybe let's say either 11/15 of 2024 or 12/20 of 2024. Let's take a look at December 20th and see what kind of premium we can get at all the different levels we discussed. Now we're talking some really good money. Remember at the $85 strike, we were getting $20. Now if you go out to December and you agree to tie up your money for a little bit longer, at that $85 strike price, you would be receiving $217 to make that trade. Now, the reason I like this is implied volatility is making this trade a little bit more exciting, and it will die down after the direction is known. So what you can do is you can go ahead and consider selling the $85 put. You would receive $217. Then if NVIDIA does go up after earnings, this that you sold for $2.17 should whittle down significantly. You can turn around maybe Friday or even the following week and buy it back for less. So that is a way that you can take a longer dated sold put and still make good money off of it. So let's assume that NVIDIA flies high after earnings. This 217 could, in the matter of just a week or so, end up being $1 or $1.50. Well, if you decided to take that trade, remember the other trade that ended at the end of the week was only going to be $20. So wouldn't you rather have half of $200 at $100 in a week than 100% of $20? This is how I make my trades safer, but I'm able to get more premium for it. So I wouldn't intend to keep my money in this. However, if NVIDIA goes down, I might have to keep it in there a little bit longer. I am getting compensated for that, though, for a higher premium. But if NVIDIA flies high, then I can cash this in at about the 50% mark, and I would still have made significantly more than the $20. So that's a way that you can look at your sold puts going out further when there's a big event like earnings, make the trade safer, and be able to enjoy more premium. Just for grins, let's go look at those other price points. So if you were looking at the $114 strike right here, look at this. You're going to receive $900 for agreeing to put up $11,400 to make this trade. Same concept as before. If NVIDIA goes down, you might have to sit tight, just hold on to this for a bit. But if NVIDIA flies high this week after earnings, you could cash this in more than likely at the 50% level, maybe as early as next week. For those of you that don't have a lot of cash but you want to get in on the action, you could do something called a put credit spread on this play. You could also do a call credit spread, but I caution you from doing a call credit spread when there's a lot of positive momentum on a stock, because that could make you wait quite a while for you to realize the gains or realize the end of the trade. So let me show you how this would work. If you're interested in doing a put credit spread, let's make this as safe as possible. We are locked in on this $85 strike. Let that be our starting point. So you may say, Ashley, thanks, that's great, but I don't have $8,500 for this trade. No problem. A put credit spread allows you to buy the put to protect the trade, and that will insulate you from having to pay $8,500 for the trade. Let me explain. If we sell this one for $217, we want to go look for another strike price that is lower that we will purchase. Let's look at the $80 strike price. That's a $5 difference between the two, so this will take $500 to make this trade. If we're going to make that trade, we're going to buy this one, and so we will make the difference between selling this one at $217 and buying this one at $161. And the risk on the trade is the difference between our two strike prices. You have 85 and 80 times 100, so that's $500. Let's see what this looks like on a ticket. When you go to your ticket, it looks like this. $85 here, same expiration date, $80 here, put, one's sell to open, one's buy to open. If you look at this, you will receive for this trade, looks like midpoint is about 46 cents, so that's $46 for the trade. You'd want to put in net credit. You'd want to populate this with the midpoint, and then let's preview to see what it looks like. This is requiring $500. However, since we're receiving 46 for the trade, it will show us 500 minus 46, but you'd still want $500 to open it up. So you could receive a 10% return on your money, which is really good in short order, especially if NVIDIA starts rising. If it starts rising, you can go ahead and close this down much sooner. It won't be 100% in profit, but if you receive like $46, maybe you decide to shut it down at about the half price point when this reaches about $23. There's a lot of ways you can work this, but this would be a really good risk to reward trade. It is a directional bet, so the only way you could really lose on this is if we get to our expiration date and NVIDIA is down below your strike prices, 85 and 80, then you would lose potentially this additional $454. But because we're doing this later in the year, and I anticipate things will be going well later in the year, I see it as a lower risk play. The last option that I have for you to consider is this NVIDIA 2 times bull shares. Now, you have to really believe in this stock and that it's going to go higher, because this will give you double the movement of NVIDIA. So if you decide to purchase this tomorrow on Monday at, let's say, $112, if NVIDIA moves by 10% or 12% after earnings, then this play will move by double that. So you're looking at potentially like a 25% move on this play. But I must caution you, it also can go down double the amount that NVIDIA. It will go down double the amount NVIDIA. So this would be a directional trade. And if you are on the losing end of this trade, you just have to be comfortable that this would be a loss, at least temporarily, until the price recovered. That ticker symbol is NVDU. Keep learning, you keep earning, and I will see you on the trading floor.